Some people say that in order to get rich, you have to be concentrated and then diversify to stay rich. But also, to get rich, you just never want to blow up.
So how do you check your conviction in an idea? And what I'm asking is, when you get excited about something and you check in with a few of your specialists and you find some agreement in this thesis, in this asset class, your framework supports it, and you start deploying some capital. Turns out you're right, the price of this asset increases. So now you're almost more right than you were last week because your bet has paid off, which can increase your confidence in that decision and encourage you to double down on that same decision, which creates blind spots because you're blinded by your own confidence. I've been down this path, maybe you have as well. How do you check your conviction in those scenarios, Lyn, when your decision's right, it's starting to pay off, but you need to make sure you're not blinded by your own success?
One is to purposely follow people that represent the other side of the argument. And so, for example, like I mentioned before, those frameworks. And then I've kind of made those frameworks my own by doing, independent analysis and kind of, my own data sets. And so now it's like my framework that's inspired by someone's framework. But,
right.
But then I follow people that have a different framework. And it might even be an opposing framework. It might say, obviously we live in the same reality. So it's not, we agree on certain points, but we might disagree on, say, 70% of the points, or might majorly disagree on timings for things like that, or obviously economics, really complex system, tons of variables. And so there could be disagreements about which variables are the bottlenecks, which ones matter more than others. And so it's really good, whatever your chosen medium is, whether it's Twitter or YouTube or following their blog or paying for their research, find people that are thoughtful but that you disagree with. So that you should be able to articulate the opposite side of your investment thesis as well as you can describe the bullish case for it, I think. So that'd be my number one. And then two, I just, most successful investors, are just dispassionate, right? So, some people say that in order to get rich, you have to be concentrated and then diversify to stay rich. But also, to get rich, you just never want to blow up, right? You never want to be over leveraged to something or too concentrated. So there's certainly a balance there where if you never kind of take conviction, you might as well buy index funds and just save time. But on the other hand, you don't want to be so exposed to something that you basically bet every single thing on a thesis, because even the best, you can never really be more than, say, 95% sure on any one thing.
Right. Yeah, it's impossible to know when there's unknown variables always at play.
Yeah.
You can be quite sure, but okay. Now, can you pull any examples? So you talked about having a framework. You referenced Ray Dalio and the long-term debt cycle. For anybody who's not familiar, if you could give us a quick highlight about what that is, what his long-term debt cycle framework is, and how that's directed any of your holdings in your portfolio.
Sure. So the long-term debt cycle, first is the short-term debt cycle, right? So the normal 5 to 10 year business cycle, credit cycle, and that's where you have during the expansion, you get more and more debt in the system. It eventually becomes a little bit too euphoric, malinvestment, and then some sort of catalyst or something, causes enough of disruption that you have a recession, a deleveraging event. But because of the system we live in, policymakers come in, they do fiscal stimulus, they cut interest rates, they do everything they can to short circuit that deleveraging. And so usually the debt to GDP, it goes down from its peak, but it doesn't go all the way down to where it started that cycle. And then you start the next cycle, building up leverage again. And so when you string multiple of those short-term business cycles together, you get higher and higher debt to GDP, and you get lower and lower interest rates.
Because it's not a full reset each time.
Exactly. Yeah. Instead of like a sine wave, it's like a sine wave that's in an upward slope.
Yes.
And so when you string a bunch of those together over multiple decades, and if you get down to zero interest rates and extremely high debt, they kind of run out of room with that system.
So that sounds familiar.
Yeah. So then they turn to asset purchases. But then even that becomes insufficient, because asset purchase, when the Federal Reserve does QE, that doesn't inject money into people's accounts. That just, they create new bank reserves, they buy treasuries. That it's basically like adding wholesale money to the banking system. It's not really getting out to the public. So then, even when that's not enough, then they turn to what Dalio would refer to as monetary policy 3, where they do large fiscal spending and then have the Federal Reserve create new base money to buy a lot of the treasuries associated with that fiscal spending. So you have monetized deficits, and that gets money directly into the hands of people and businesses. And so if you look, there was a paper by BlackRock published in 2019. Stanley Fischer from the former Fed was also an advisor with that paper. And they talked about, this was before the pandemic, they said in the next downturn, interest rates are so low, debt's so high, there's not a lot of policy space. And so what's going to happen most likely is we're going to have to, bring interest rates to zero, do large fiscal support of some type, could even be helicopter money. And then any inflation that comes from that, we're going to have to hold rates low anyway for a period of time. And that's just kind of what we find ourselves in. And so that they basically were saying we're in long-term debt cycle territory here. And it's funny because that's exactly how this played out. I mean, obviously we added complications to the mix with the coronavirus, but essentially we've gone through that playbook, and that's also the playbook that Dalio was talking about. So ironically, it's almost like you're so bearish that you're bullish when it comes to equities. So going back to the question of what do you buy and how does it influence a portfolio? What separates a long-term debt cycle, the way that gets resolved historically, is a currency devaluation. So you inflate away enough of the debt that you have a lower debt to GDP ratio because the nominal GDP went up enough. And that's historically, and then you can do that. You can thread the needle, like say the United States did in the 40s and kind of that's the last time we were in the long-term debt cycle, the 30s and 40s. So you don't have, say, a hyperinflation. You have if you were holding treasuries throughout the 40s, you lost between 30 and 40% of your purchasing power holding what is supposedly the safest investment in the world. Right. So that's the good case. And then of course there's a range of cases. If you were in Europe or other places, you generally lost more. And of course there are some countries, some emerging markets where you'd have a total loss if you're primarily holding currencies or bonds. So that's generally how a long-term debt cycle resolves. And so when you're identifying this, you're saying, okay, sovereign debt to GDP is very, very high. They're kind of stuck. If they have deflation, it can cause serious financial problems. And at the same time, if they have inflation, unlike the 70s, where debt was low, they could raise rates back then to contain it. They really can't raise rates now too much because it renders the sovereign, insolvent. And so because they control the printing press, they pretty much by definition can't be insolvent in nominal terms, just in real terms. So that's the situation we kind of find ourselves in. And so it comes down to managing the timeline of that, right? Because some people could be a decade early. Other people could not see it coming at all. And so ideally what you want is see it coming and then also know what signposts or things to monitor along the way.